If you've been hearing the term Trump account everywhere lately, let's clear something up first. This is not about politics. This is about tax rules. And a lot of what you're seeing online right now is either incomplete or just flat out wrong. If I told you there's an account designed for children, not a savings account, not an education account, and not based on the child having a job, you'd probably want to understand what it really is before forming an opinion.
Wait, no job, no W-2? How does a kid even have an account like that?
Exactly. That's what we're breaking down today. Not politics, just tax rules. Let's start with the basics, because the name is where most people get distracted. The legal name of a Trump account is a Section 530A account, but the name itself isn't the important part. The structure is. Here's the simplest way to understand it. This is a long-term account designed specifically for minors. And structurally, it behaves much more like a retirement account than a regular savings account. That distinction matters. This isn't flexible spending money. It's not something designed for short-term use, and it's not built for casual withdrawals. From the IRS point of view, this account exists to sit inside the tax system for a long time, with restrictions that reflect that purpose.
So is it a Roth IRA or a 529 plan?
Neither. Those accounts assume something different as the starting point. A Roth assumes adulthood and earned income. A 529 assumes education as the primary goal. This account starts earlier than both. Think of it as a bridge into the retirement system that exists before adulthood. It introduces structure first, before flexibility, before access, and before optimization ever becomes relevant. This account works in two phases, and this is where most misunderstandings start to creep in. Phase 1 runs while the child is still a minor. And during this phase, the rules are intentionally tight. Access is limited. Flexibility is limited. Not because the system is unfinished, but because it's doing exactly what it was designed to do. This phase is built for growth, not spending. It's meant to exist quietly inside the tax system, accumulating over time, without the option to treat it like a short-term resource. From the IRS perspective, those restrictions aren't accidental. They're what keep the account aligned with its purpose before adult tax rules ever apply.
So before 18, the rules are stricter?
Exactly, and that's on purpose. The restrictions aren't a downside. They're the control mechanism. They keep the account focused on long-term growth and prevent it from drifting into something it was never meant to be. Timing matters. These rules apply to tax years starting after December 31st, 2025. But there's an important detail. No contributions are allowed before July 4th, 2026.
What about the government's $1,000?
That's a pilot program. It only applies to children born between January 1st, 2025 and December 31st, 2028. A child doesn't open this account themselves. That's the first boundary the law sets. This isn't something that happens automatically, and it isn't something a minor can initiate on their own. An authorized adult makes the election, most commonly a parent or a legal guardian. The IRS treats this as a deliberate decision, not a default outcome of having a child. And there's an additional requirement when the government's pilot contribution is involved. In that case, the election must be made by the person who expects to claim the child as a dependent. That link matters. It ties the account back to existing dependency rules, instead of creating a separate track inside the tax system.
So this isn't automatic?
Correct. Nothing here happens by default. No election means no account, and no election means no access to any of the related rules or benefits. During the growth phase, there are several allowed funding sources, and the key thing to understand is this. Not all money is treated the same once it enters the account. Where the money comes from determines how the IRS classifies it and how it's treated later. First is the government pilot contribution. It's a one-time, $1,000 amount. It's not taxable to the child, and it does not create basis. It's designed to start the account, nothing more. Second, there are qualified contributions from government programs or eligible charitable organizations. These contributions are also not taxable to the child, and they are not counted toward the $5,000 annual family contribution limit. That simply means they are treated separately, not that they can be contributed freely or without limits. They must come from qualifying programs or organizations, and they remain subject to eligibility rules, program requirements, and oversight within the tax system. Same account, different source, different rules. The third source is employer contributions under Section 128.
Employers can contribute to a child's account?
Yes. For the business, these are deductible fringe benefits, not wages paid to the child. That distinction matters. Wages trigger payroll reporting. Fringe benefits don't. For 2026, employer contributions are capped at $2,500 per child per year and count toward the overall annual limit. There's one more category of contributions to understand, and this one works differently from everything we've talked about so far. Parents, grandparents, or even the child can also contribute to the account during the growth phase. These contributions are important for one reason in particular. They create basis. That means the IRS treats this money differently later on, because it's clearly identified as after-tax contributions made by family members or the account holder. But these contributions are kept. There is a $5,000 total annual limit per child, with that limit adjusted for inflation starting in 2027. And this part is critical. That $5,000 limit is not per source. It's not per person. It's the total across all family-based contributions combined. That's why contribution type matters here. Different money enters the account under different rules, and those differences don't disappear over time. They follow the money forward. Investment choices inside this account are intentionally limited. The focus is on low-cost, US-focused index mutual funds or ETFs. No leverage, no speculative strategies, no complexity layered on top of the structure. That simplicity is deliberate. It keeps the account aligned with long-term growth, not short-term decision-making. And before age 18, there's one rule that overrides everything else. Distributions are essentially prohibited.
So the money is locked?
Yes, by design. The lock-in isn't a drawback. It's the feature that makes the system work. If the money were easy to access, it would invite short-term use, and that would undermine the entire structure. Turning 18 does not trigger tax. Age alone does nothing. What matters is what you do next. There are 3 possible outcomes. Outcome 1, do nothing. The account continues under retirement account rules. No tax. No penalty. Outcome 2, withdraw contributions. Amounts that created basis can generally be withdrawn without additional tax. Outcome 3, withdraw growth. Growth is subject to normal retirement account tax rules, depending on timing. 3 simple planning examples. Example 1, younger children. More time, more flexibility later. Example 2, teens close to 18. Smaller balances. Set the structure once, then let it run. Example 3, employer plus family contributions, legally placing money into the system early. This is Ivy Smart Tax. We don't tell families what to do. We help them understand their options.
Because confusion is expensive.
If this helped, save this video. And if it raised more questions than answers, that's normal. This video is for educational purposes only and does not provide individual tax advice. Always review your own situation before taking action.